Have you ever noticed that a new product can explode in popularity, but after some years, its growth begins to slow down? Why doesn't it keep growing forever? The answer lies in one of the most powerful mathematical models in economics and finance, the logistic growth model. Today, I'll show you the mathematics behind it using a simple financial example. Exponential growth. Exponential growth equation. This equation assumes growth never stops. In this equation, P implies certain customers. Small letter r is the growth rate, whereas the small letter t is equal to time involved. Imagine a new investment app launches. Initial users equal to 1,000. Monthly growth equal to 40%. The first month, month 1. In this month 1, 1,000 subscribers or initial users will multiply the 40%, which is 1.4, to give 1,400. In month 2, that 1,400 already gotten after month 1 will multiply another 1.4, which is 40%, to give 1,960. At the end of month 3, 1,960 will multiply 1.4 to give you 2,744. Continue. By month 6, you will have 7,530. Month 12 will be equal to 56,700. Can this continue forever? This growth, can it continue forever? The answer is no. The growth slows. And here are the reasons growth slows. 1. Market becomes saturated. Secondly, competition increases. Thirdly, fewer new customers remain. And then again, advertising becomes less effective. Now, in real market, there is always a limit. You cannot sell smartphones to more people than actually exist, giving us a graph with a kind of X shape, as can be seen demonstrated on your screen. This X-shaped curve is called a logistic curve. Now, let me give you the logistic growth formula, where K is equal to carrying capacity, maximum market size. Now, suppose K is equal to 100,000 customers and your R is 0.5, which is 5%, taking your initial customers to be equal to 1,000. Now find A. You have to substitute these values, the values for these variables, into the formula. This equation tells us the market grows rapidly at first, but gradually slows as it approaches 100,000 customers. Let me give you financial examples where you see this occurrence in our day-to-day living. You see this occurrence in investment platforms. For example, suppose a company earns $10 profit per customer each month. Calculate profit. In month 0, the customer will be equal to 1,000, meaning the profit will be 1,000 times $10, giving you a total of $10,000. At middle stage, the customers will be equal to 40,000, making a profit of 40,000 multiplied by $10 to give you $400,000. Huge increase, yeah? But at near saturation, customers is equal to 95,000. Profit is 95,000 times $10, which is equal to $950,000. After another year, customer becomes 97,000, making a profit of $970,000. Here, notice something. Profit is still increasing, but much more slowly, meaning the market is becoming saturated. I'll give you why investors care about logistic growth in markets. See it in this investors' advantage. 1. Predicts future revenue. 2. Estimates company value. Take 3. Decide when to buy stocks. The last but not the least, avoid expecting impossible growth. If investors understand logistics growth, they won't assume a company's earning can grow exponentially forever. Instead, they will recognize when growth is naturally slowing because the market is nearing its limits. Now, let's see a real-life example. You can observe this in real-life businesses like the smartphone business, Netflix, Facebook, mobile banking, ride-sharing apps. Note, every successful business eventually reaches a stage where finding new customers becomes increasingly difficult. And that's why most companies eventually transition from explosive growth to steady, slow growth. In conclusion, in this box, you have fast growth and slowing growth and stable markets. The mathematics of logistic growth teaches us that every market has limits. The greatest financial advantage comes from identifying businesses while they are still in the rapid growth phase before they approach market saturation. Understanding this model helps investors make more realistic forecasts, value companies more accurately, and avoid expecting unlimited growth. Guys, if you enjoy learning the mathematics behind market growth, subscribe for more financial mathematics lessons where we break down real-world investing, economics, and wealth-building concepts into simple equations anyone can understand. Don't forget to like, share, and leave us a comment with the next financial topic you would like me to explain.